Focus. Ideate. Innovate. Enable.
GJEPC, in association with State Bank of India, organized a finance summit on the theme Diamond Financing, New Opportunities, New Realities. The event was held in Mumbai recently, and the focus of the event was to create understanding in the banking sector and awareness in the trade about the changing compliance requirements affecting cost of finance and due diligence required to be adopted by the trade for maintaining a healthy portfolio of such financing of the sector. Here are some of the key highlights from the event.
Welcome to Diamond Financing Seminar. Ladies and gentlemen, let's hear it for the Chairman of the Gem and Jewellery Export Promotion Council, Mr. Praveen Shankar Pandya.
The initial push came from the Indian banks when they saw this industry growing, and then Bank of India, Bank of Baroda, and later State Bank, they all started financing the industry. So it was the financing which helped us grow. We are standing at a juncture when we need to take strong actions to put this industry back into the growth path.
As banker, I feel very, very happy to be here because this dialogue between industry and financiers is always welcome. Unless the industry knows the lenders' problems and lenders know the industry's problems, we will not be able to move forward.
The diamond industry is possibly one of the first outsourcing industries for India. In the early 60s, India served as a low-cost cutting center where polishing activities were outsourced to. Over time, our companies developed their polishing enterprise expertise on the near gem or Indian affordable diamonds and gradually became world-leading polishing companies in their own rights. More recently, the sector has gone through challenging times both globally and within India. Additionally, post the 2008 financial crisis, banking regulations have also seen modified significantly. These changes have forced both diamanteurs as well as our bankers to start adapting their traditional financing models in India as well as globally.
हम सबसे ज्यादा व्यापार डायमंड में करते हैं. दुनिया में सबसे अच्छा काम हमारे देश में होता है और एक्सपोर्ट भी, जो आंकड़े मेरे सामने रखे गए आपके माध्यम से, सबसे ज्यादा एक्सपोर्ट भी हम करते हैं. और अभी ये वक्त की आवश्यकता है जीरो इंपोर्ट, जीरो इफेक्ट और जीरो डिफेक्ट.
To lead the discussion, please welcome Executive Editor, CNBC TV 18, Latha Venkatesh.
Let me start with you, Mr. Pandya, though you have had your say. In brief, is there a new problem in terms of diamond financing? After all, if the industry has grown to service 70% of the global diamonds, it cannot have been done without the banking sector already servicing it very well.
There has not been a significant change in the financing of the industry, but yes, there is a crisis of confidence among the bankers, because today we have 40 bankers in India who are financing the industry. Not many of them have really understood the industry very well. But when the going was great and we were having double-digit growth year after year, and there was no NPAs, even not knowing the industry was okay. And economic slowdown after 2008, the industry is having a sluggish growth. I would say probably it is flat. So in this period, there have been some stresses in the industry. We have to admit that. So I would not say that the bankers have been very supportive of our industry, but we want to address the crisis of confidence that they have lately developed, and this is largely because of their ignorance about the industry, the peculiarness about the industry. So a few who have gone under stress do not represent the industry.
Okay. Well, Mr. Sekhar, to you that question. Do you see the diamond industry going through the same problems that any other sector in India is facing now? Extra cautious bankers because of slowdown in growth, and because of the rise in NPLs?
Just one or two things before we go there, Lata. Diamond industry, diamond financing, State Bank of India, we were very, very happy. See, actually, I can recall one incident where almost 8 years back I went to a diamond branch, which exclusively deals in diamond financing. There I could see percentage of stressed nil, 0. So reason for that.
Was this 2008?
Before that. Reason for that was, even if some small stress is in some unit, entire industry would be after that particular unit, and then they will bring back that unit to discipline. So we were very, very happy. And as you say, one or two instances, if something happens in the industry, definitely bankers would become cautious, but that doesn't mean that we will totally stop. And if I talk about this diamond financing branch of Bombay, almost 40% of the finance is going only to MSME. So there also there is no contraction. But only thing they are asking is issues like ECGC, issues like external credit rating. Those things, of course, we are also examining with an open mind, and we have an exclusive policy for diamond financing in our bank.
Russell, what is the problem then? If there is an annual input taking by the bank to sort out the industry-specific issues, why don't you place it on the table right away if they are going to renew their yearly analysis of the diamond sector and its features?
Okay, I look at it a little differently. I think, every industry is going through issues, and every industry has bad apples, and every industry has NPAs and things like that. So to typecast diamond industry has got some bigger issues, I don't believe it. Now, based on banks' own perceptions and own views and own ways of deriving their margins and their bottom line, they charge the way they want to charge. They will ask for whatever collateral they want, and hence every bank has a different way of looking at the industry. In the diamond industry, I believe that the bank should invest more in relationship banking. So they should be looking at the promoters on a regular basis, over and beyond their balance sheets.
But, Mr. Jayakumar, is there a problem of doing homework, as the diamond industry seems to suggest? A lot of legwork is needed from the bankers themselves, a lot of due diligence. Is that not forthcoming from the banks?
I think, not only diamond industry, but, all our industries are going through changes in structures. And then there is a need for all of us to relearn and then bring in new methodologies, etc. So I think that's really what it is. Are the bankers sitting back in their offices and not meeting clients? I don't think you can have a universal position on that. But in general, state-owned banks, with the exception of SBI probably, are probably a little bit, you could say, a bias, but I'm nobody to comment on that. So what I would say is this, that all said and done, if for us at least, if the NPAs are twice of what we have elsewhere, and that elsewhere average is also elevated, it does put into question. And then you overimpose that with people not wanting to deliberately pay, in our experience, that adds to it. And finally, of course, this is a discretionary demand and therefore more susceptible to changes in economic condition.
Mr. Patnaik, is there something that you want to share with fellow bankers and with, more importantly, the industry? First, the fellow bankers on how is this sector different, and therefore are different skills called for from the banker?
Two parts, like Russell Bhai said, it's while choosing a client, it's more a client than an industry, and look at all the key risks associated with the client. Also an industry, we have been both in AV and AMRO, because this business migrated to this bank, as you said. There was probably, like Eric is here, he always says bankability is transparency and profitability. And how to find out whether a number is real or not. That should be, like Russell said, the risk management function of the bank should have those discerning eye to find out whether it's a real number or it is manipulated. But is this the norm for the entire industry? No. This is not the norm. This is probably very specific. One needs to find out the good ones from the bad ones.
To give us insights into diamond financing, let's hear it for George Abraham.
When you look at the diamond industry, you look traditionally at the global centers, Antwerp, India, Africa, London, where the trading was done historically. And when we thought of starting financing for this segment, we had the option, bring in an expert or learn the business yourself. And today in the morning, everyone was talking about understanding the business. So we took the time and trouble to understand the business by talking to the diamond players, understanding what they require, what their challenges are, talking to our fellow banks like ABN, ADB, who helped and guided us along the way. And thank you for that, because they educated us about the trials and pitfalls that we could avoid, and that's helped us a lot.
In another session of GJEPC Diamond Financing Seminar 2017, in association with State Bank of India, Vada Shine, former CEO of T. Beers Diamond Trading Company, chaired the business session, Emerging Opportunities in Diamond Finance.
So, first of all, what do you mean when you talk about corporatize? What do you mean when you talk about professionalize?
It's about the strategy, it's about the motivation of the sponsors, it is about the composition of the management team, it's about a transparent structure.
As far as corporatization and professionalism, both are synonymous. Corporatization means putting into place a platform and a process and a methodology which enables businesses to plan for the future. Professionalism and corporatization go hand in hand. The best run companies are the ones which have a vision, which have a future, and they have the right sort of processes and controls in place.
Thank you. And Walter, from institutional investors, does it change? Is it different to what the banks are requiring?
I don't think so. I think we look at it, first of all, maybe more like maybe the analogy would be software. Some of the software might be, for example, credit policies. We like to see credit policies. We like to see credit policies updated. We like to see them followed. We like to see maybe a credit committee within some of these larger firms that make credit decisions with respect to their clients and how much credit to extend and when to pull back and when to extend out. And we'd like to see that followed. And then there's, of course, hardware, more of the mechanisms, the individuals that are making those decisions and whatnot. So I think I agree with all the comments made earlier. When you do due diligence on players in the sector, you get a very different feeling if you visit someone and they say, here's our credit manual, here's our exceptions, here's our reports, here's our committee members. These are where we've learned some lessons and we've adjusted our approach, versus sitting down when someone just verbally goes through all the war stories over the past couple of years. So this type of infrastructure really presents to us some evidence about the approach that's used.
Rajiv, I'd like to ask you, as someone who's actually been through this transition of putting systems and processes into your business. First of all, how difficult it was. Second, how expensive it was. And third, is it going to fit every business, or is it a certain size of business that can do that?
Demexon began its corporatization journey back in 2004. And I can tell you today that the word professionalism and corporatization are the most misunderstood words in our industry. They are misunderstood because it took us as a company internally about 2 to 3 years for the culture to set in. We define corporatization as a mindset change. Coming to cost, I think the scale is an important requirement in order to professionalize in terms of implementing ERPs or implementing procedures or policies. But really you don't require any of those. If you are a company that has a turnover of 200 crores and you really want to get to the next stage, and getting to the next stage means transparency, good governance, and providing investor confidence.
What is the common interest rate that peer-to-peer or crowdfinancing are charging? And second, how does the platform give the assurance, or what happens in case of, so it's because the interest rate is very high, the risk is higher, or what assurance does the platform give?
Risk lies in the end with the individual investor who puts his money up. There are certain platforms who have sort of built in some sort of trade insurance and things like that, but really most of the time, and especially in the example that I mentioned, the risk lays still with the investor. The role of the platform is to have the knowledge to do the risk assessment, to do diligence, and to give clear and transparent information to the investors to give them the comfort that there is a low likelihood of things going wrong. And if you look at it in other industries, actually, default rates are lower. We think that's for a couple of reasons. Number one, it is using technology in a very smart way to assess ability and willingness to repay. So if you then look at the interest rates that are related to that, because there is a risk for the investor. So for that unsecured invoice financing, investors were happy to earn anywhere between 0.8 and 1.1% per month. I think if you can bring more security in, if you can bring more transparency, you can bring that down significantly.
GJEPC Diamond Seminar 2017 in association with State Bank of India also focused on financing small and medium companies in India. Distinguished bankers presented their views and opinions on financing MSME sector in India.
Generally, because of the relationship which has been established, bankers do try to deviate and endorse that, though there is a provision, but in this industry it's being a sensitive. The risk is very high, which always bankers have experienced for the last few years, where the GJEPC can think and facilitate bankers who can really have a strong trust to have in these activities. Whenever any export happens, the other side of the agency which are located in any country, you need to have some of the similar bodies in such countries to certify, say that yes, this is their background. Some sort of a KYC, what they said, somebody said that KYC should be done. This need to be given so that there is a comfort. Otherwise, the challenge will be there on a banker alone for taking such a decision. I am not saying that all the exports which are going to happen, it is going to have an hit, but one incident stuck, it really gets stuck.
Trade bring more transparency, that's what we are telling. By transparency, what I mean, what you tell, you follow that. By transparent, you have to be truthful. That is fundamental requirement. So this is one requirement from the trade. And if the common will of GJEPC and BDB and Mumbai Traders Association prevails, then these things can be implemented.
There were certain takeaways that I've noted down, and I think I'll just sum it up in a very short way. To start with, we clearly know that there are some issues that we have. They may be small, they may be large, but I just like to kind of itemize it in four things. One is, there is a lack of transparency that we all agree. Second, there is lack of solid collateral. And we know that as an industry, we've had provided collateral, and perhaps those requirements are going up for whatever reason, but there is lack of real solid collateral. Third, as an industry, we're not a growing industry, and bankers like growth. Perhaps we can focus on growth and earnings. Maybe that is an important aspect to focus on. Not top line, but bottom line. And fourth, but most important, is reputational aspects. Reputation as an industry, we need to work upon. So let's focus on doing things right. Let's focus on making change. And I think as a collective team, we are certainly in the best place position with the top leaders to get that change implemented. Thank you very much.
I don't think banks in general are leaving the diamond industry. We see some banks pulling out, some international banks, for different reasons, but nothing to do with the underlying diamond industry. And fortunately, we see a lot of other banks coming in, and not only banks, but also financial intermediaries, financial institutions, and investors getting into the industry. In Asia, here in India, but also in Antwerp, in Dubai, and even Africa. So we see a lot of regained interest from financial institutions into the diamond industry.
Bankers have never lost the confidence on gems and jewelry. This was a temporary phase when gems and jewelry industry has faced some stress. It doesn't mean bank has lost the confidence. We are still supporting. Even in the crisis also, banks were supporting to gem and jewelry industries. And still we are continuing. Rather, nowadays there is a great scope for the business. Now we are extending our support and multiplying our support rather.
challenges which are being offered by the market, the company who is responding to this challenge in a more innovative way will be the company who will survive on a longer term. See, for diamond industry, actually what we are selling is, we are selling a hope to the people by and large. So the retailers will have to continue to market this particular product so that there is a demand which continues in the market. And second is that the companies will have to constantly innovate in order to improve their production or the productivity so that they are able to maintain their margin.